Hello and welcome back to a brand new video on the channel. In today's video, we have a video discussing order blocks, which is something every ICT trader talks about. Half of them don't actually understand them and the other half are explaining them wrong. I've been trading now for 8 years and I've used order blocks as one of my key references for every trade that I take, if it's there and I can see it. So today I'm going to break it down so clearly that even if you've never placed a trade in your life, you'll finish this video knowing exactly what they are and how to use them. So let's dive straight in. Before we get into it, if you're new here, welcome. I'm GJ. I trade Forex. I use ICT concepts and I also trade futures. And I've been doing this for 8 years now, and it has been around 5 of them years I've been using this ICT concept in my trading. I'm not here to sell you a dream. I'm here to actually teach you something useful. So drop a comment below if you've heard of order blocks but never really understood them. I guarantee it's most of you watching this, and that's fine. So let's get straight into it. Okay, so what actually is an order block? Here's the simple version. Big banks and hedge funds and institutions, these guys are moving hundreds of millions, sometimes billions through the market every single day. And here's the problem they have that you and I don't. They can't just buy or sell all of it at once. Why? Because if Goldman Sachs tries to buy $1 billion worth of GBP USD in one go, the market moves against them before they've even finished buying. They'd be pushing the price up with their own order and they'd end up paying more than what they wanted to. So what do they do instead? They split the order, they buy in stages, they get some filled at one price level, then they wait. And here's the key bit. They leave the rest of their order sitting there unfilled, waiting. That level where they left their unfilled orders, that's your order block. When price comes back to that level, those remaining institutional orders get triggered, and that creates a reaction, and a very strong one, as you can see on the screen, because you've got massive institutional money all activating at the same price. That's it. That's the concept. It's not complicated. It's just where the big money left their homework. So let me give you an analogy that's going to click permanently. Imagine Tesco or Target orders 10,000 units of a product from a supplier, but the supplier can only deliver 6,000 straight away. The other 4,000 are coming later. Tesco still needs those 4,000. The order is still open. So when the supply comes back around with the remaining stock, Tesco buys immediately, no hesitation, because they already committed to that price. Banks work exactly the same with price levels. They commit to buying or selling at a specific level and whatever the price it is. So when price comes back, they fill the rest, and that's what drives the reaction you see on the chart. Next time you see the price shoot from a level, for no obvious reason, there's your answer. That's Tesco filling their remaining stock order. So it's as simple as that. So there are two types of order blocks, bullish and bearish. See this strong move here? Now look at the last red candle before that move happened. That candle right there, that's your bullish order block. Why the last red candle? Because that's where the institutions were placing their buy orders before the move. They were buying into that bearish candle, accumulating their position before pushing price back up. So when price comes back down to that zone like this, back to that last red candle, that's your buy signal. Institutions are still there and they're going to fill the remaining of their orders from this level. Entry at the order block, stop loss below it, same thing in reverse. So price will come back into this bearish order block, and then from there we can find an entry. So when price comes back to that last red candle, that's your buy signal. So you would be taking buys to continue this trend from this bullish order block. And it's the same thing in reverse. So a strong move down now find the last green candle before that drop. That's your bearish order block. Institutions were selling into that bullish candle before pushing price down. When price retraces back up to that zone, that's your sell. Entry at the order block, stop loss above it, take profit at the next low. Simple, two types, same logic, just different direction. Moving on, let's talk about some real life chart examples. So here you can see price made a strong bullish move. I identified the last bearish candle inside of here, and this would be your bullish order block. Price came back down. We create these nice lows just above the order block to create some liquidity before price runs higher. Stop loss would go just below the order block, and then your TP could be wherever you want to target. So why? Because these type of candle structures are only institutional buy-ins. So let's use the Tesco analogy once again. We've ordered 10,000, or they want 10,000 at this price down here inside of this order block at this exact price level because they've sold off price. little to no wick, and we've closed very bearish. However, they still need to get 4,000 more units in stock for the Tesco analogy. So that's what they do here. They drive price for their 6,000 units, and when price goes back into the order block, they then sell at that same price for the remaining units they want to buy or sell at that specific price level. In this circumstance, it was a sell. So in this circumstance, you would take your short position and you would put your stops just above this high over here, which is the invalidation of the order block. And then your take profit could just be these lows down here. Very simple. The main 3 mistakes I see beginners make with order blocks consistently and constantly is train every order block you see. So this is not an order block. This, however, is an order block. What makes it an order block? You want order blocks that form at key levels, previous highs, previous lows, areas of liquidity. A random order block in the middle of a range, skip it. It's not going to work for you. The second mistake I see is no confirmation before entry. Don't just enter the second price touches inside of the order block. Wait for a confirmation on the lower time frames. On your 15-minute, wait for a rejection candle, a change of character on the lower time frame. Something that tells you price is actually respecting that level before you put money on it. And then the final mistake I see is if your order block is on a 5-minute chart, but the hour is showing a downtrend, that bullish order block means nothing. Always check the higher time frame first, so your daily, your weekly, and your 4-hour, before heading down to the lower time frames. Get those 3 things right, and your order blocks will look completely different. So that's order blocks for you. 8 years of training, 1 video. Hopefully that actually made sense. If you want to learn or get my free analysis, all of my discords are in the link in the description. Completely free, no catch. If this video helped you, please subscribe to the channel, as I'm dropping educational video like this every week. And drop a comment. Let me know if you want me to cover fair value gaps next or certain types of liquidity, because that paired with order blocks is where it gets really interesting. So I'll see you all in the next video. Peace.